I'm Jessica Minton for IB Times TV, and I'm here on the floor of the New York Stock Exchange, where stocks actually rose today after China made a surprise move by cutting interest rates. But comments by Federal Reserve Chairman Ben Bernanke disappointed investors looking for further stimulus measures. Jonathan Corpina from Meridian Equity Partners will be speaking to us about Bernanke's comments, as well as China's surprise move and Fitch Ratings downgrading Spain's credit rating to BBB. Federal Reserve Chairman Ben Bernanke announced on Thursday the U.S. central bank was ready to protect the economy if financial troubles increase, but offered few clues that further monetary stimulus was coming. Bernanke told Congress the Fed was monitoring significant risks to the U.S. economy from Europe's debt and banking crisis closely, but for financial markets hungry for clues about the prospect for a third round of quantitative easing, Bernanke's testimony disappointed. Federal Reserve Chairman Ben Bernanke met with Congress earlier today, but gave few hints that there would be more economic stimulus. What are your thoughts on the prospects of more quantitative easing?
You know, I think this has been a topic that's been on the table for a while, and it's actually somewhat refreshing to get a little bit more information coming out of Washington. Usually when we get these comments coming out of Washington, whether they're prepared statements or off the cuff, they play the cards very close to their chest. They don't really open up and give investors or give Wall Street or Main Street any real clarity as to what the thought process is or where it's going. So the comments that we heard, I think, opens the door a little bit for the possibility of QE3, and I think investors want to know whether you agree with it or not, just to have some sort of plan in place or some sort of path that we might be going down. To have a light at the end of the tunnel is helpful for investors, and we're seeing that in a reactionary measure in our markets today.
China delivered a surprise on Thursday by cutting borrowing costs to combat weakening growth, while giving banks additional flexibility to set competitive lending and deposit rates. China's first rate cut since the global financial crisis stressed heightened concern among policymakers worldwide that the Eurozone's increasing debt crisis is threatening economic growth. And then China made a surprise move today and cut interest rates by 25 basis points. What do you think this will do for the global economy while we're still having problems going on in Europe?
I mean, that was a pretty aggressive move, and I don't think anyone was really expecting that to happen today. Maybe in the next couple of months or quarters, but clearly not today. So maybe that just brings everyone to the table a little quicker now to see what measures are out there that is going to help our economy, that is going to help our global economy, and what can we do, collectively to learn off of each other, what other countries are doing and how that's going to affect their markets there now. So clearly we can see what happened in China. I think everyone else is taking a step back and saying, I want to watch and see how this plays out, and maybe we could do the same thing too, or maybe we can learn from their mistakes. A little too soon to tell, but I like the aggressiveness.
The European Central Bank left interest rates at 1% on Wednesday, which disappointed expectations that it might move quickly to combat fears about the health of the Eurozone. Markets were unsure how the ECB would react to the recent wave of weak economic data, knowing that the bank also wants to keep the pressure on the Eurozone leaders to tackle the crisis more effectively. And the ECB announced yesterday that they're leaving interest rates at 1%. What do you think that'll do for the global markets?
Once again, I think that's the opposite side of that trade there. That's a kind of a passive move. We were expecting it. Anything else would have been an extraordinary measure. So that motion there is really what we were expecting. At this point right now, there's so much turmoil that's going on in Europe. I don't think we're going to see an aggressive move at this point. It's been going on for such a long time. We're all getting pretty tired of having the same headlines and having the same conversations. I think everyone wants to see some sort of effect, but nobody wants to make that first move. A little fragile situation there. Make sure that the right moves are going to happen, because if you have a domino effect, we're talking Greece, Germany, Spain, we're going to have a big fallout there. So we need to make sure that that's going to happen properly.
Fitch Ratings downgraded Spain's long-term foreign and local currency issuer default ratings to BBB from A.
Ahora estamos en la fase más difícil, que es sanear unas cuentas públicas que no estaban bien y que es capitalizar a unos bancos y hacer unas reformas que eran necesarias. Pero si no hacemos eso, créame que no vamos a ninguna.
The dramatic decline of Spain's sovereign credit profile and ratings over the last year, in Fitch's opinion, reflects policy missteps at the European level that have aggravated the economic and financial challenges facing Spain as it seeks to rebalance and restructure the economy. Fitch Ratings downgraded Spain to BBB. What do you think that'll do for Spain's decision in trying to get their banks in order and to seek help?
From that point of view, I think the bank system there is struggling, to say the least, and the downgrade is not that we weren't expecting, or no one, I think, can really debate the fact that it should be higher. But the fact is they do have a problem. There are some issues there. That might spur their government to move a little quicker, to put a little bit more influence on trying to find a solution there. Everyone is playing things such a slow play. And the longer it goes on, everyone gets very uneasy, whether it's here, whether it's in Europe. We want to know what's going on. Whether you're on Wall Street or Main Street, people want transparency. They want information to be able to make the best decisions possible. So the longer this goes on, I think it's going to hurt our markets. But clearly, we're starting to see some little glimmers of hope in Europe and in China that some of the right steps are moving in the right direction, bringing the right parties to the table, making sure that everyone's having the same conversation in the same room. We're seeing glimmers of hope here in the United States. Some of the economic data is showing some stability, showing some growth, maybe not as fast as what everyone's looking for, but clearly what we've seen in the markets over the last 2 days, investors are using this as an opportunity to feel good about the markets.
Fitch Ratings also announced today that it would cut the United States credit rating next year if Washington didn't create a credible fiscal policy. Bernanke's comments today left little room for further economic stimulus, but he did say that if troubles did persist, the U.S. Central Bank was ready to act. Thanks for watching. I'm Jessica Minton for IB Times TV.